Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Enviva. I've got the chart up right here. This is the actual 6-month chart. I also included in the video thumbnail. And it's been dropping like crazy. We saw some, things earlier on this year. They cut the dividend. Results weren't as expected. But even recently, this is 6 months. And even if I go to the past month, the stock is down a lot. And I'm trying to figure out why. And so I wanted to sort of walk through things today and let you know how I'm thinking about the company and go through that. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I do currently hold a long position in Enviva, and I've been buying more recently. That's foreshadowing to what I'm going to talk about today. So just FYI, and this video should be for entertainment purposes only, because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. All right, so as I said, it has been dropping, and now I think it hit a 52-week low, maybe an all-time low, I'm not sure, of $3.84 on Friday. And just when I think it, can't go any lower, it keeps going down. And so I'm just grasping at straws trying to figure out why is it dropping and dropping and dropping, because to me, this seems like it's getting more and more undervalued. And so let me kind of walk through some of that. So we did get their Q2 earnings. I didn't go through that on my channel. I'll briefly walk through that today. If you're unfamiliar with the company, here's like the 15-second overview. They are a wood pellet producer. They source wood. Here, I guess maybe this slide is a little better. They source wood from kind of waste, what's left over, usually what's left over from, after they've gotten all of the, actual timber that they can use for wood products, for logs and everything else. And then they take that and they dry it and they form into these pellets and they ship it over and they sell it to customers. A lot of their customers, I think, are utility companies that sell them for generating electricity over in Europe and in Asia. This is like a brief summary of their business model. And I believe I think it said there, yeah, they're the largest industrial grade wood pellet producer right now. They have the capacity, let's say if everything was operating properly, of 6.2 million metric tons per year right now. And they have this big backlog of, $23 billion worth over many, many years, more than a decade, of contracts with customers. So this company is already fairly well established, and they've got some growth coming, which I'll touch on later. This is an overview of their assets, and this is, by the way, is their investor presentation that came out after Q2 of 2023. You can find it right on their website if you want to take a look at it yourself. And this shows some of the plants that they already have, some of these plants that they have in progress. One is actually under construction right now. This one I believe this is one in Alabama, and then they have another one where they're basically getting ready to get the EPC contract. I think they plan in Q4, and then going to make a decision on that soon in terms of whether they move forward or not. One here in Missouri? Sorry, there's my geography lack of knowledge coming through. I think that's Missouri. So, anyways, let me walk through some of the numbers, because that's really where it gets interesting in my opinion. So I'll state up front, right? Their numbers, they did not meet their initial guidance for this year. They didn't meet their Q1, didn't meet their guidance from the end of last year, and then Q2 didn't meet their guidance from the end of Q1. So I believe that is in large part, I think that is a part of the story as to why they keep going down. I think maybe people are getting more and more pessimistic. But even looking at their guidance now, which has been adjusted downwards, twice in the past 2 quarters, it's the stock seems that the stock has been going down more than I would have expected. Let me put it that way. So they had in Q2 fairly slim margins of $10.4 million. Now there's some legitimate things to adjust out of that. That's their gross margin, and get to their adjusted EBITDA of $26 million. I'm going to walk through a couple of those items in just a moment, so what they're including in those adjustments here. But so that gives you your Q2 numbers. But one thing to know about Enviva is that they're cyclical, and their Q3 and their Q4 historically have been much higher margin quarters, higher revenue and higher margin, I believe. And so this is their guidance for the year, where they said, yeah, in Q1 we had adjusted EBITDA of let's say $8 million. Forget about, for now, I'm going to ignore these two bars here and just say Q1 was $8 million of adjusted EBITDA. Q2 was $26 million of adjusted EBITDA. And then they expect 70 in Q3 and 130 in Q4. This is pretty typical. I think if you look at last year, I could probably pull it up. I'm not going to do it right at this moment. But if you look at last year, you'll see that there's a similar pattern where Q3 and Q4 were their big moneymaker quarters. And there's no reason to expect that won't also be true again this year. And so we have the best quarters coming up. They're going to make some money here, unless things really, really go to pieces. And not only that, they really emphasize this on their Q2 numbers. They're implementing some cost reductions. They already did some corporate restructuring, which should make things better going forward. And then they also have some actual operational improvements. They talked a lot, or a fair bit in the earnings call about using so much contract labor and just kind of poor planning on their part. And they said, okay, we've now that we've identified what the issue is, we believe that the costs are going to come down, and they're implementing this across their plants going forward. And so this is their projection here, where these bars here are showing the breakdown of the costs and where these costs were in on the left here is month by month, on the right is by quarter. And they say Q1 and in Q1 was when we kind of got surprised and we said, oh wait, that's when we looked into it, said what's going on, why are our costs higher than what we initially expected at the end of the year. And then so in Q2 they sort of diagnosed it, identified it, and believe that they've started to address it in earnest. And that's where you see in June, they're illustrating here that June was their lowest delivered at port cost, right? So this excludes all the transportation, which is its own thing. But this is the cost per metric ton of their wood pellets, actually, going through all the sourcing and the processing, getting to the port where they would be shipping it out to customers. So again, there are more costs even after that. The transportation to actually get it to the customer, I think that sort of varies the degree to which Enviva is on the hook for that versus the customer. I don't know that we have a lot of insight into that, but this delivered at port cost applies to everything they sell, or most of it at least. Some of it they do contract with third parties, but for most of it is here, right? And so that's a meaningful number for them to track and to manage to. And they believe that they started getting this down with some of these things that they implemented in Q2, and they had the very, very first piece of evidence here in June. And then by Q3 and Q4, they expect to have even more improvements, and they expect that, again, that cost to get down to, they say 130 135. And so that would be pretty material, because they're shipping, I don't know, 5 to 6 million metric tons per year, and a $20 reduction, even over Q2 on a per metric ton basis would be 5 million. If it's 5 million metric tons per year, which I think they ship a little bit more than that, and they have the capacity for a bit above 6, but just let's round down and be conservative. 5 million metric tons per year times that $20, if I can do my math correctly, would be $100 million per year, in cost savings. And I have to imagine that these cost reductions, this is their target year-end run rate. I'm pretty sure that's already built into these projections for Q3 and Q4 in terms of the EBITDA. So these EBITDA numbers probably already include that reduced cost. But if you carry this forward and you look at, well, what would this year have been had they already had those in place? Q1 and Q2 obviously don't include those. And so I think as we look forward to 2024, if they actually achieve these cost reductions, you'll see that actually carries forward even into next year. So I did say that I wanted to go through their adjustments to talk about what their adjusted EBITDA really means. And they have a pretty reasonable reconciliation of that down in slide 32. Let me zoom in just a tad bit here so that you can see. And so they said their gross margins were $10.4 million. And then they call that's not the one that I want. Sorry. I want their EBITDA. I was looking at the wrong slide. So we're actually on slide 33. And so this is just in Q1. I'm looking at these numbers here, this first column. And their net loss was $55.8 million. We're talking EBITDA, so of course we add back in the depreciation, amortization, and the interest. Now, the rest of these are sort of the subjective adjustments that you would include on there. I think, changes in derivatives that were unrealized gains. Obviously, sorry, I shouldn't say obviously, but I totally agree with that. Now, they have this loss and disposal of assets and impairment of assets. They do have a little bit of this each quarter. these are non-cash expenses as far as I understand. I think these are things that they sold. Now they sold below the holding value on their balance sheet. And so again, I don't think these are, cash cash expenses that they're incurring. So it makes sense to exclude these from EBITDA in my opinion. Now, go to equity-based compensation. This one is one. This is one that companies, from what I've seen, in my opinion, will abuse when they're trying to make the numbers look better. They'll throw out, hey, here's our EBITDA numbers, where EBITDA excludes, some of the stock-based compensation. And, I think that's a very real expense for a lot of businesses. What you need to understand, or what as I read through this and what I understood, is that a large portion of this is actually part of the restructuring expense. And if you come down here, you can say that you can see the footnote number 2. You can see that this $17.2 million of non-cash equity-based compensation includes $10.4 million that was in connection with the restructuring. So we would expect that to be a one-time expense, to not recur. And so going forward, I think this is really more like $6.8 million of an adjustment. So I think this is, using their metric as stated, I think is a little bit too rosy, but I don't think they're that far off. Then they also have some actual cash expenses that were part of the restructuring. Part of that was severance. Maybe all of it was severance. They don't really specify. And that's $2.7 million. Again, I'm willing to believe them in saying that these are one-time expenses. So on a going forward basis, it wouldn't be that significant. And so we get down to an adjusted EBITDA number that they call 26 million. In my opinion, I would subtract off, to get a meaningful number for valuation, I would subtract off that $6.8 million of equity-based compensation that was not part of the restructuring. So if we look at this 26, subtract off this 6.2, sorry, 6.8, gets you down slightly below, and so it gets you to like a $20 million of adjusted EBITDA. Now, let's try to look at the full year picture for 2023, and we're going to look at EBITDA, we're going to look at cash flow from operations, and try to come up with a valuation, or just let you know how I am valuing the company right now, how I'm looking at it. So let me zoom out just a tad bit so we can read this a little bit better. Now, if we look at their projections for the year, and again, I think this includes some cost improvements that they plan. They do have plans for that. And you look at their range here for the year, we're talking 200 to 250 million. If everything goes well, it's at 250. Or closer to 250, their midpoint here is let's just call it 225. And they do call out a couple of things, a couple of the reasons why they revised. They had this extended outage as they were expanding one of the plants. They also talked about, some things shifted from Q3 to Q4. And in fact, some of it, I think, shifted into Q4 from Q1 here. But the point is, Q4 is going to be good based on everything that they're seeing and some of the actual detailed understanding that they have of which particular shipments are going out when. And so, I think this projections, we'll wait and see what the company, how they actually deliver. But they seem like they have very tangible reasons as to why these projections are what they are. And so we look at the full year range. We are looking at $250 million of adjusted EBITDA. I think you could even call that conservative for a steady state going forward basis, based on what I said of some of the cost improvements that were not included in H1 that they do think are going to be in H2 if that carries forward to 2024. But even at this valuation, right? So $250 million of EBITDA. They also have a nice slide that just goes over what their current, debt is, their current enterprise value. And so this outstanding shares, the value of outstanding shares has dropped quite a bit. And so if we're looking at this, the actual net debt, this was at the end of Q2. Let's assume that this is roughly about where they're still at, $1,252 million. Add on the current value, current market cap of Enviva, which is, let's round off, $286 million. Gets us to an enterprise value of just a tad over $1.5 billion. Now, if we go back here and we're looking at their EBITDA for the year, if they hit the low point of their adjusted EBITDA range, it's 200. Let's subtract off that 6.8 million, call it, round it out off to 7, call it 193. I think that's probably kind of I call it quite a rounding error. $7 million is significant to this company, but let's just let's use it just for the sake of valuing the company and trying to be slightly more accurate. At the high end of this EV to EBITDA multiple, we're looking at a tad under 8. And if instead we use the top end of this range, which would be $243 million EBITDA, we're looking at 6.33. And so we're looking at somewhere between 6 and 8 enterprise value EBITDA if they meet these projections, which seems a bit undervalued. But another way that I want to look at this is actually their cash flow, because I think because of this huge backlog they have and some of their expansion capabilities or expansion plans, not even just capabilities, but they have this $23 billion backlog. I think they have pretty good visibility into the future. So for them to be actually, undervalued is a bit laughable when they have all of these, sort of factors that make them more stable, right? We know that this is going to continue, or we shouldn't say we know, but we expect if they can just manage their costs, which seems very well in their ability to do at this point. They had fairly reasonable explanations as to what they're going to do. They're tangible. They're not just guessing. They're tangible, and they've already got the revenue side taken care of through these contracts, and these contracts have, as I said, built-in price escalators over time, so they're not going to be flat. They are going to just go up naturally over time. And so we're looking at 6 to 8 for EV to EBITDA, which seems low, and very low when there's multiple factors as to why they will grow in the future. But if we look at cash flows, let's look at this here, right? So we've got this adjusted EBITDA range, $250 million per year. They only use the midpoint here on the slide, 225, but they say, hey, we're going to eat up some of that just in working capital changes. Okay, fine. So that brings us down $25 million. Then they're going to pay, interest. They do have debt. They're going to pay interest of $80 million for the year. That gets them to, at the midpoint, $120 million for the year in cash flow from operations. They do have some CapEx that they have to do just to sort of, maintain their plants, of course. And they do have guidance on that of about $20 million, right? They say their maintenance CapEx is very low, $20 million per year. And so if we come back here, we're looking at this 120, which again is the midpoint of their EBITDA range. Walk that down for their cash flow from operations. Subtract off 20 for their maintenance CapEx. You're looking at $100 million at the midpoint of free cash flow for the company. Unless I miss something, that's free cash flow to the company that they will have from this year, right? And so you look at the stock, and the stock is just going down and down and down. And people, I think, I've seen comments online of people saying, this company's going to bankruptcy, they're losing money. But I mean, they're at the midpoint of their range going to have $100 million in free cash flow. And let me remind you, the market cap is $286 million. So if they hit that mid range, that's a price to free cash flow of 2.86. 2.86 price to free cash flow. This seems just incredibly undervalued. And again, they've got these long-term this long-term backlog of contracts, and so I think they have this stability. It's not like I wouldn't expect things to just surprisingly drop like crazy next year because of that. And I didn't talk too much about it yet, so let me find it in here. Sorry, I'm looking. So they talk about the expansion that they have for this new plant, right? This, I don't know how you pronounce it, Epes, Alabama, I'm not sure, but they have this, construction is underway on this plant. This is going to give them another 1,100, let's call it 1.1 million metric tons per year in processing capacity. And so let's go back here and we look at this has a good overview of all of their existing plants. They say their current processing capacity is 6.2 million metric tons per year. This one plant that is under construction is going to increase it by 1.1. So that is, do the math, 1.1 over 6.2. That's going to be a 17, roughly a 17% increase, maybe 18% if you round it, in their overall production capacity. And they've said in the past, as far as I understand, that this one is already, they already have contracts for that capacity. And so like people are waiting. They're going to start selling that as soon as this plant is online and can produce wood pellets. And so and they say these plants cost them $375 million to build. That's their estimate. I don't know if it's in this particular. I'm looking for it. I don't know if it's in this particular presentation. They've stated that in the past. But they do state here that they think each of these plants, that's this, a 1.1 million tons per 1.1 million metric tons per year in design, is going to give them a 5x multiple in terms of their the EBITDA that they can get versus their investment. And that they expect that to get $75 to $90 million per year in EBITDA per plant. And so that I think is expected to come online in mid 2024. So even in next year, there's this growth, 17% growth from this plant that's already underway, and that debt is already included here. I think most of the cost, where was that slide that had their debt listed out? So here, this is the Alabama, or the Alabama tax exempt senior bonds. This is part of the cash that's on hand, part of the bonds that they have here. And I'm sure they're going to draw a little bit from their, from their revolving credit facility to spend to pay for the rest of that plant. But then they're going to immediately turn that around and be producing wood pellets from that plant. So they're going to be expanding, and it's they've got a very tangible plan. I keep saying that word tangible because I think all of their plans make sense, and so that's why it's really. I'm having a hard time understanding why this is trading now where it is. It seems very undervalued. But again, for full transparency, I have been buying. I bought more just on Friday. I probably will buy more this week if the stock continues trading in a similar range. I think if you look forward and you say, well, let's look at let's use rough projections here, right? So cash flow from operations after CapEx, after maintenance CapEx was, $100 million in this year. Or let's just do the enterprise value to EBITDA, right? Because that's a little bit easier. You don't have to make so many assumptions. 250 for this year. Let's go with the low range here, $200 million in EBITDA. They have this cost savings that I think would have given them about another $50 million in H1 if they were able to save 20, well, hang on, let me do the math. So I have the numbers in between Q1 and Q2. They delivered 1.19 plus 1.302, just about 2.5 million, metric tons of wood. So times $20, yeah. So that'd be roughly $50 million in savings if they hit the $20 million, or sorry, $20 per metric ton in savings that they believe they can get with by the end of this year. Add that 50 to this low range here to the bottom of the range, 200 plus 50. If I can type, 200 plus 50, right? So that gets us to $250 million in EBITDA next year, in 2024, just from their cost savings, if everything else stays the same. Now you look at it and you say, okay, they are going to expand, and they're going to have this new plant. Let's say by the end of next year, their EBITDA run rate, let's say they get the bottom end of their range for $75 to $90 million per plant that they expect. That gets them to $325 million, sort of at the bottom of all of these ranges of projections. Again, it could be even higher, but the bottom of, there. And so let's say, they said it cost $375 million for their actual, where is it at? For the plant construction. They have $1.25 billion of debt right now, 1.25, but they've already got $250 million from these bonds. So let's say they need another $125 million. Add that on, they have $1.375 billion in debt. Add on their current market cap, I believe was 286. So now you're 1.6. Let's just call it 1.7, right? So 1.7. I think, what did I come up with? Put in millions. $1,700 million in terms of enterprise value. I think I just said they were 375 for their actual EBITDA. And so now you're under 5 for enterprise value to EBITDA, if I did all my math correctly there for 2024. You're looking at cash flow. They're going to add on a little bit more interest from whatever they borrow from their revolver. Let's call it $125 million they borrow from that revolver. Let's say they end up paying, let's be conservative and say it's a 10% interest, right? So that's $12.5 million per year in, additional interest payments from what they borrowed to finish off the plant. $12.5 million. So hang on. So they were at 120 minus 20 for maintenance capex. They were at $100 million of, roughly at the midpoint free cash flow for this year. Subtract off that 12.5, and I guess let's subtract off the 25 to put it down at the bottom of the range of EBITDA. But then let's add on what is at the bottom of their EBITDA range here for actually having that plant online. So that'd be $137 million per year. And so you look at that valuation, 137.5, divided into this 286 divided by 137.5. That would be a price of free cash flow of like 2. And then if they have those cost savings that I also mentioned, that would drive it even lower, right? And so this is like end of 2024. The price of free cash flow would be crazy, crazy low in my opinion. And there's even more. I'm gonna have to make another video because I don't want this to go on too long. It's already been over 20 minutes at this point, 25 minutes. Wow. They've also, I'm just gonna call it out and then I'll hop off. There's nobody on the chat, so I don't know. I'm just gonna wrap this up. They also talked about applying for some tax credits under the new Inflation Reduction Act, and they have that for both of these plants. And then they also talked about not having to go to the capital markets, right? And I'm not sure where this is. They said, hey, we might be able to defer our construction on this. Again, evaluating construction deferral dependent on cost reduction, and they're going to make a decision in, I think somewhere they said, Q1 of 2024. Now, that I think might, it's possible that could depend to some degree on these tax credits, because I think they're supposed to hear back in Q1 of 2024. I will go through that in more detail in the future. But you look at that, and then you also say that, hey, once they start to have some cash in the bank, they also had, let's see, I don't know where it's at on, if it's even in this slide deck. They also had, they have the ability to, they authorize share repurchases. Now, what happens to this stock? What happens to the stock if they spend some of that $100 million that was authorized earlier this year to buy back the stock when it's at $3.84? I mean, as of right now, they could buy back a huge portion of the company, like a third of the company at the current market price. Even if it was up at $5, they could buy a quarter of the company, I think, and a quarter of the outstanding stock. That would be, just a massive reduction in the shares. And, if they were able to do that, let's say they hold off on, sorry, I'm getting ahead of myself. Sorry. I thought I was going to wrap this up. I will do it, very, very briefly. But I'm just throwing a hypothetical of what happens if they go here, they defer this plant in Bond, Mississippi. So they have all that cash on hand. They say, you know what? That lets us have the flexibility to finish off this plant without having to borrow and buy back some stock. Or maybe they borrow temporarily under the revolver, buy back the stock. They know they can pay back the revolver pretty quickly because they were able to defer this. And they hold off on some of these plans as well, because they just say, we're so criminally undervalued, we're going to buy back the stock right now. And, what happens if they could buy back a quarter of the company? And they're able to fund this without having to take on a lot more debt. And, and then later on, they can, borrow more for this once they're in a very solid place. It's just, there's a lot of, and again, so this is for anybody who's watched this long and has listened to me, hopefully you appreciate this. But, hopefully you are interested in the company you've looked at, let me know in the comments or email me. It should be in my YouTube profile to be able to email me. If you think I missed something, I think there's even more topics I could talk about. There's the legislation in Europe. I took out, the Renewable Energy Directive 3 that they, that could be a wild card. I've done my best to look at. I think that there's no real surprises for Enviva past what they already said earlier this year. I'm not positive on that. Again, that would be, I don't want this to go on too much longer to show you what I've got, but I will hopefully do that in the future if there's no update from the company soon on that. But again, let me know if you think I missed some major reason as to why it's really trading down. What am I missing? What's the major bear case that is making people trade at $3.84, right? As to why it's not closer to at least even, double or even triple this value. I didn't even get to a couple of the other bullet points I had because I've talked so much. There was the insider purchases that they had earlier, insider slash other funds that are already been invested in, presumably have already have large stakes and have talked to management. Yeah. All right. I'm gonna hop off. That was a lot for today. Thank you very much for watching, and have a good one.